I'll show you a concept which just doesn't fail. It's easy to replicate, and I've used this exact same method to sustain over an 80% win rate with over 150 trades over 9 months. It's accuracy based retail trading on the higher time frame, and it doesn't need to be complicated and subjective. Fewer refined variables are a lot more efficient and easier to scale. The magic you're looking for is in the work you're avoiding, and in this game that work is the patience, discipline, self-awareness, self-control, journaling, the thing that most people avoid. I'll give you the building blocks for consistent profits where only you stand in your own way. We'll start off with identifying zones, and then I'll show you how to find the best case scenario, which is essentially playing chess with the markets. The tech always remains the same, but how you play it depends on the fundamentals, which we'll cover, which is one thing which gets developed over time and with experience. So I do break that down for free on my Discord, but you can trade without understanding fundamentals one bit, just playing a bit defensive and knowing what zones not to take. Fundamentals is one of those things which is likely to confuse you in the beginning, and it gets developed over time because you have to understand the perception, you have to learn to read between the lines and kind of anticipate how big money will perceive the news event. And fundamentals, it's more psychology than actual economics, so I'll show you how to just avoid it and not to get smashed by it. You don't take all the trades, you only take them where the odds are in your favor on top of just technicals, and this way you might miss out on a few trades, but the ones that you do take have a high chance of delivering. Understanding market drivers and conditions, again, every zone is not a valid zone. It totally depends on the market condition, if it's a tech market or a funded driven market. Also, what is driving the market, if it's risk sentiment, if it's dollar, and so on. And then I'll show you an entry and exit model, and this is very important because this is how you extract money from the markets, where you enter and where you cash your positions. And finally, we'll go over how to journal, refine, and repeat based on data, not based on how you feel, and then I'll show you a bunch of live examples. So in terms of identifying the zones, we'll start off with levels because this is the foundation to my technical trading. I do have a video on my channel which goes more in depth on levels and also fibs and price action, the concept of a breach of a zone to increase the appeal of the next one, and they'll all be linked in the description, but I will go over it in this video as well. So with levels, there's 3 levels. You've got the weekly, the daily, and 4-hour levels. Weekly levels are start of a trend. They usually deliver over 1,000 pips, and they usually deliver a move that lasts from a couple of weeks to a couple of months. In some cases where a weekly zone has delivered a move for quite a few weeks but it hasn't breached the previous weekly zone, can still be considered as a weekly zone, but however you consider them, you have to kind of approach them the exact same way. It's more so just for data collection. At the end of the day, the price behaves very similarly, and if you apply the logic, it's the same thing, but it's just in terms of data collection, it will just give you a better understanding of your edge, because even if you trade the exact same strategy as me, the way you trade it will be different based on your risk appetite, your lifestyle, your strengths and weaknesses, and so on. But essentially, the start of a trend on the weekly time frame is a weekly level. Now, if this weekly zone was to have broken this zone and price pushed lower, that would have made this a stronger weekly level because that indicates more selling pressure. Once you've got all your weekly zones, in between them you'll have a bunch of daily zones, and daily zones are essentially just pullbacks and continuations of the overall trend. The bigger and sharper the pullback from these levels and continuation, the stronger the level. But essentially between all the daily levels there's a bunch of 4-hour levels which I won't plot, but essentially levels which you can't really see on the daily time frame. Once you have all your levels plotted, the other technical confluences that I use are fibs, trendline, third touch, 100 and 200 daily or weekly EMAs, also the 200 SMA at times, fib extensions but rarely, and also trendline duplicates but rarely. Key levels and fibs and key levels with another solid confluence in the right condition is more than good enough to take as a zone. But essentially over here you've got all the levels marked out. So you've got this daily level, this is a daily level, another daily level, and you've got a 4-hour level, another 4-hour level, break retest, and also this 4-hour level. Then what you do is you plot the most recent, the biggest, and the most obvious fibs of significant moves. So since this is a downtrend and we're looking at pullbacks and continuation of the overall trend, we're seeing where price can pull back to and continue in the direction of the overall trend. So in terms of sell case scenarios, this is the biggest fib that you can see, and what you'll notice is that this daily level is on a 50 fib, the 61 is also on this break retest, and the 38 is on a 4-hour level. We can also see how the 23, Yeah, you could kind of say that the 23 is on this 4-hour level as well. Remember, when it comes to levels, recent price action is king, so you're only looking at this area of price, where price was when it was last at that area. You're not looking at any of these realistically, only sometimes for a break retest. You then plot the most recent fib, and as you can see, the 50 is with this break retest. How I would play this is breach of 38 to increase the appeal of 50 in a tech market, depending on how far away it is, but more so I would prefer something like this. Or if it does deliver the move, then a breach of this to increase the appeal of this one. But that's something we'll talk about when finding the best case scenario. For now, it's just identifying all the zones. You can also see how this fib has been reacting, and when you extend it, it also aligns with a few of these. Once you have all the fibs marked, you can plot any trend lines, any EMAs. So this EMA could potentially align with this zone. You then begin to make ideal case scenarios. So now this is all them levels, just without all the things drawn on. So you should annotate next to your areas of interest all the technical confluences that the zone has, but I have gotten rid of all the fibs, trend lines and EMAs just to make it a bit clearer. So if this was a potential trade setup, exactly how I would play it is a breach of this zone to increase the appeal of this zone, and if it does do the move from here, then I'd want a breach of this zone to increase the appeal of this zone. However, if this zone does deliver, I now want a breach of this to increase the appeal of this zone, with this as a backup. So for the backup, I'll make that red. And same scenario over here, if it breaches this zone and you've taken this one but it breaches this as well, then your backup has a really high chance of delivering, because remember, this is the daily time frame, and especially because it's a daily level, the odds of profit taking, especially when these two are breached, is a lot higher. So you'll do something like this. But for now, you're just planning out all the scenarios like chess, where the odds of profit taking or your pullback happening are more than just technicals, where you'll disregard some zones which, yes, they might deliver the move and you might miss out, but for the sake of accuracy. But once you can read the markets like this, you can see this is my exact plan and how I would play it in each scenario. Again, at the very minimum, you never take a trade on its own. You'd at least want a breach to increase the appeal of the backup. There are other things on top of technicals which improve the odds of success, such as timing or alignment, but that is not something which I'll cover in this video. I think too much information is likely to confuse you. This concept alone can sustain 70-80+% win rate without even understanding fundamentals. In a technical driven market, most of the levels are likely to give a pullback, and the reason for that is there's not much fundamentals which is influencing price, and that means the technicals is of interest to most of the market participants, as that's the main source of reference. When there is a fundamental driver, you do tend to see a breach of multiple zones, and again, I do have a video which goes more in depth in how to trade fundamentals. But essentially, if there is a news release, the best way to do it is remove any trades 250 pips away. Even if price does push to your zone, which is 250 pips away, the odds of profit taking is high, and if your zone gets breached, the odds of the backup delivering is also high. Yes, even with news, and the reason for that is algorithms will be taking profits, and when there's a sharp move into a zone, especially after breaching a few zones, even if the news keeps pushing price higher, and the odds of profit taking on zones which are a far distance, so something more than 250 plus pips away, is likely to deliver. And that way you can actually trade news without even understanding it. In terms of drivers, you need to know what's driving the market as well. So if it is dollar driven, if it is risk sentiment, if there is dollar news, it is likely dollar driven, but sometimes that can shift the risk sentiment, essentially risk on and risk off, which is the market's risk appetite as a whole. So risk on is when they prefer riskier investments, they're a bit more greedy, a bit more optimistic. So you see riskier assets such as stocks pushing higher, and gold, which is a safe haven, push lower. And on the flip side, on risk off markets, safe havens flow, so money flows into yen, into gold, into other safe havens, and out of risky investments such as the Nasdaq and the stock market. But now let's talk about the entry and exit model. So in terms of entry, it's simply just a few pips before the first confluence, and the way you draw these boxes is the start of the box is the first technical confluence, the end of the box is the last technical confluence. The stop loss should be a few pips above the last confluence, where it should give it breathing room. The last place you'd want stop losses are round numbers, you'd rather cover them. And in terms of take profit, I would suggest starting off with a 1-to-1, and get good at getting in and out and your stop loss placement. But once you are confident in doing that and confident in picking the most obvious setups, then you can learn to extract a bit more from the markets. Maybe you see a break retest like this with a fib is a good place to take partials. But again, if trading is a marathon and not a sprint, stop trying to sprint, learn to walk. Usually what happens is when you play a bit more aggressive, when you try make more than what you are capable of, especially consistently, then you are trying to run and you're more likely to fall. And what tends to happen is, for the sake of a few days worth of gain, you set yourself back weak. So get good with a 1-to-1 and start tracking how much your zones are delivering and adjust your take profits based on that. Another reason why 1-to-1 is very solid is because you'll have a high win rate. It will give you a lot of confidence, and you can leave a 10% runner where, let's say if price pushes to your entry and it does the initial pullback. Now if price is to continue pushing higher, you have still made money because you've cashed most of your position at the initial pullback. Remember, the way we're trading is a breach of a zone to increase the appeal of the next one. If the zone before was breached, the odds of profit taking at your level is very high, and even when momentum is against you and price continues to push higher, the whole goal is to cash on this initial pullback. And if it does give the move, then you can use this runner to take a risk-free counter. And a good way of doing this is, let's say this stop loss is 30 pips and you leave a 10% runner. If price was to come back to the low, and let's say this is 300 pips away, and now you've made a completely free buy from leaving just 10% on the table. It is also a lot easier to predict this profit taking move compared to the bigger move, because for the bigger move to happen, there's a lot more variables that you have to anticipate, and even if price does start pushing higher, you've still made money in this case. If you want to understand this strategy in more depth, I do break it down in my Discord. So we've gone over identifying the zones, which is starting with the key levels and adding everything on top of it. I showed you how to find the best case scenarios, which in some scenarios you might miss some trades, but the ones that you do take have a high chance of delivering. A fundamental outlook, which is broken down in my Discord, but a way to trade it without even understanding the news events. The market drivers and market conditions, which again is a bit more complicated. I've just explained it in a very basic way. Entry and exit model, which is cashing most of your position at the initial pullback at the profit taking move, because it's a lot easier to predict. Finally, journaling, refining and repeating. Journaling is essential to understand how you see the market. It is collecting data and going based on that data, not based on how you feel. And this is the most objective way of doing it. Even if you don't think that you're getting much from the journal, over time, when you have a large data set, it's much more valuable, and it's something that will help you understand your edge in much more depth. And that is very important in what market conditions, what type of setups work, and that will help you be more confident in your trading with large capital. And it's essential for scalability. There is no holy grail in trading, but if there was, it would be journaling. So now let's have a look at a few examples. We'll start on the second week of January this year. So I was looking at the 38 plus 4-hour level and a weekly break retest. In the technical market, I wanted a breach of this zone and a strong push into the zone to take it. And if this got breached, the odds of the backup delivering were a bit higher. If it did deliver the move, then I'd want a breach of the zone after to increase the appeal of the zone after that. Bounce of the 38, breach of 50 to increase the appeal of the 61. This is something that I kind of explained in this video, but also I talk about in my fib video and my price action video, where you want a breach of a zone to increase the appeal of the zone after, and the logic behind why that works. And again, since it was a tech driven market, as you can see that the 38 fib 4-hour level weekly break retest did deliver the move, because Monday in a tech driven market, no fundamental driver. So as I explained before as well, in a technical market, the levels are likely to work. I still do play it a bit safe in technical markets, so if sometimes it's likely to make the move off this break retest, and in cases like that I do miss out, but at least I know when I do take a trade, the chances of that delivering is stupidly high, especially in the tech market. If a breach of that zone happens, then the backup is very likely to deliver. In this case, the 50 fib and the backup level did deliver the move as well. And again, this is a scenario where I do miss out on the 50 fib because I played it a bit safe. Because the 38 delivered, I wanted a breach of the next zone to increase the appeal of the zone after. And then when price price pushed higher, the 27.25 area, it did align with silver on the 61 fib, and it was around 5:30, so end of session, and the chances of this delivering were pretty good, especially with a strong move into the zone. And that's something on top of just technicals, which in this scenario was end of session and also silver on level. And because of the same concept, because 27.25 delivered the move, and when price pushed back higher, I was no longer interested in the 27.50, because if 27.25 was breached on the way up, then I would have definitely taken this and the odds of success were stupidly high. But because 27.25 did deliver the move, and then we were coming up, and also because of this strong daily close, and it was early into the week and I couldn't pin the driver, I wanted a breach of this zone to increase the appeal of this zone, and this zone got breached and the backup did deliver the move. And since it delivered a 250 pip pullback from 27.60, I now wanted timing or alignment on 27.70, if not a breach, to increase the appeal of all-time highs. We didn't get timing or alignment on this 4-hour break retest and psychological level, so we waited for a breach, but it did miss the all-time highs. Currently, I have sent out my breakdown, and it's essentially breach of highs to increase the appeal of psychological level. I do send a weekly fundamental breakdown trying to give you my view on that fundamental perception, and again, it's something that I am working on, but I do get right most of the time for the time being, but sometimes I am a bit wrong. But even if I am wrong, the tech still has a solid chance of delivering, and the stats speak for themselves. Hopefully this was helpful. If you have any questions, you know where to find me. Trade safe. Have an amazing 2025.